Morgan with you at the PDAC 2018. On my right, Nick Barisheff. Nick and I have known each other for quite some time. Nick, thanks for coming today.
Oh, my pleasure always to meet with you, David.
You know, you spearheaded something that's been kind of a pet peeve of mine, which means that most portfolio managers do not admit the simple fact that they need diversification. They allocate stocks and bonds and think they're diversified.
Right.
But you know better. You did an Ibbotson study, or paid for one, years ago. Can you tell us about that?
Well, the first thing Ibbotson pointed out is that there's 7 asset classes, not 3. So you have cash, stocks, bonds, and then you have real estate, commodities, precious metals, and collectibles. So for financial planning purposes, you can take collectibles off the table, but in Europe, high net worth managers include collectibles. And since I'm a bit of a car buff, I always like to use the example that I think it was in 1967 Ferrari Daytona was 17,000 brand new, 2.5 million today, and it outperformed the Dow in any stock market going, and you could drive it Sunday afternoons. But anyways, let's take the collectibles off the table. So then we're left with cash, stocks, bonds, real estate, commodities, and precious metals. Commodities is a difficult one because you can't buy, for the average Joe, commodities. You can't buy a truckload of lumber, for example. All you can get is derivatives and proxies of commodities. So they're a little bit off to the side for pure commodities players. But the rest, there's easy to buy for any portfolio. So we've had REITs for 2 or 3 decades. We've had our mutual funds since 2002, and so on. So you can always implement with those. And the issue that Ibbotson pointed out, they had their models, but they did a variety of runs in terms of how much gold you need to protect for inflation and so on. And the numbers are quite simple. In their case, it came out to about 7–8%. But if you ask the question differently, is how much gold do you need to optimize the portfolio under normal conditions? So we've set up our own model and have run those examples, and like if you had held 20% in gold over the past 10 years, that would have optimized the portfolio. You would have reduced the standard deviation, you would have increased the overall returns, and you would have cut the losses, the drawdowns in say like 208, by more than half. So to me, it's a fairly simple exercise, and I can't understand why all the portfolio managers aren't doing this, because it's not brain surgery. They can set up your own model. We've got a giant Excel file. I can plug in, any portfolio you want, and add any percentage gold that you want, and you get the answer. Right.
Well, what's interesting is CPM Group, Jeffrey Christian, has done a similar analysis, and he's presented it at the Silver Summit 2 years in a row. And both years I've actually asked him on our mastermind, like you've been on, and it's the same number basically. It's 20%, and that sounds very high.
Right.
But it is what it is. You can't argue with the fact. And the fact is, with a 20% weighting in gold, you're better under all, I would say all conditions. Under conditions for the last 10 years at least.
Well, there are conditions in major market declines where you can argue 100%.
Right.
Okay, but that's like temporary, and then you redeploy it. But like if you forget about those, then 20% across the board is the optimum number between. If you go more than 20%, the return improves, but the standard deviation goes higher. Right. So if you're trying to get the optimum in between those, then that's the number.
Going back to Ibbotson briefly, if I remember correctly, I think they had like a 15.7% or something under all economic conditions. I mean, it was fairly high.
Yeah.
And that's like anything you can throw at it. So even in the best of times, if you have gold in your portfolio, it's going to outperform for safe risk to reward profile.
That's right.
My problem is that this is actually known by some financial planners, yet they're basically taught that they're diversified with stocks, bonds, and cash, which isn't true. And we all know that. So can you outline
the word
that?
Actually, diversification is holding non-correlated assets. And Harry Markowitz, I mean, he won a Nobel Prize for this particular point. And that is that it doesn't matter if you're holding 200 stocks or two, okay? The 200 stocks don't give you any more diversification because they're all correlated. You know, and it doesn't matter whether they're emerging market, blue chip, whatever, because when the market goes up or down, they all go up or down together. So you need something that's non-correlated. The most non-correlated asset class to the traditional assets is gold. So by putting it in a portfolio, it will always improve the portfolio because of this correlation thing. So that's kind of a straight black and white fact.
Right. So I would love to see like the Silver Institute, the World Gold Council, you know, that are helping the industry make this better known. I mean, it doesn't seem to be, it's an open secret that no one pays attention to. Wall Street doesn't pay attention to it. Obviously they're in the stocks and bonds model. They don't get much money for gold.
Right.
Even if you're in a wealth management situation where you have $5 million portfolio or up and you get a special phone number and your own broker. Even in those cases, very seldom they put you into gold, and if they do, it's like a weighting of, you know, 0.5% or something.
Yeah, we see the same thing. You know, one of my big underestimations was when I started the fund in 2002, was that I thought it would be welcomed with open arms and so on, and it wasn't. And I found out, you know, the hard way that there was kind of this negative bias against gold, which is being perpetrated by the central banks and so on. So okay, I get that. But the same thing applies to real estate. Now, as you know, my background is real estate. So when you look at, over the past 40 years, which asset class, if you take real estate, precious metals, stocks, and bonds, and which asset class has been the best performing the most often over the 40 years, real estate is number one at 17 years. Gold's number two at 12 years. Stocks are at 7. Okay? But if you look at the so-called balanced fund and the balanced portfolio, they don't have either. They don't have real estate and they don't have gold. Okay? And yet they're calling them balanced diversified funds or anything but.
Yeah. So what would you do to get the word out? I mean, you've already paid for the Ibbotson study, you have a spreadsheet, you make this point very often, you make it in your literature, your writings, sometimes when you speak, yet it's kind of deaf ears right now.
The trouble is it's one by one. We offer to financial advisors, say, look, you've got a portfolio that you recommend to your clients, so tell us what that is, we'll do the spreadsheet, and we'll show you what your portfolio would have looked like with 5, 10, 15, and 20% gold. And then it becomes like straight factual.
Right.
So that's the only seemingly way we can get through is kind of one-on-one, which is an extremely slow, painful process.
Right. Well, David Harquil, CEO of Franco-Nevada, was interviewed by Kitco at the BMO conference just a week or two ago. Right. And he said, as chairman of the Gold Council, of the World Gold Council, that he was going to bring in April some sovereign wealth funds, some pension funds, some other fund manager types, and he was going to actually have Alan Greenspan speak to these people about the requirement. Oh, I say requirement, I want to mix my words and say he said, he implied that you need gold in a portfolio.
Right.
And I think coming from someone as esteemed as Greenspan, people will listen.
Right.
Do you think that this will have any effect? I mean, I think it's important for the World Gold Council to promote gold in the correct way, which means it's a head position in most cases. It balances a portfolio. It makes you sleep better at night. I mean, it performs its function.
Right. But like I say, there's kind of this mental block that many financial advisors have. We've met with many of them. And the issue is that what they don't realize is they think that they really don't want to get into this realm of gold and recommend it to their clients and blah, blah, blah. But what they don't realize is when the market crashes, not if, and those high net worth clients are having lunch together, and I'm moaning and complaining saying, shit, that was a real shit kicking I took in the markets and lost 50, 60% of my portfolio, and you say, well, Nick, I didn't lose any because my financial advisor put me into gold. And what I lost on the markets, I made it up in gold. So I'm going to say, what's your financial advisor's name, David? That kind of thing is the way it happens. And in some cases at a high net worth, the guys that have, tens of millions with you.
Sure.
I've dealt with them over my entire career. These are not the guys you want to piss off.
Right. Yeah.
Okay.
Well, I agree. I mean, my scenario is one of my overused expressions, once the ship is sunk, everyone knows how it might have been saved. Yeah. So if you have gold in your portfolio, it's going to save you during a market crash. But try to tell that ahead of time, and people give you the short shrift, they don't want to talk to you.
But here's another thing where the complacency comes in, because this is part of the extended speech like I did in Barbados, and that's the issue, and I'm rounding out numbers, but there's about 300 trillion of global financial assets. Stocks, bonds, mortgages. When you look at the above ground gold, you ignore the central bank holdings, the jewelry and so on, and then in terms of what I call investment grade gold, that's 1.8 trillion. But we don't know how much of that is held by the world's wealthiest families, like the Rothschilds. That isn't ever going to be for sale. But let's say it's the whole 1.8 is available, and the market tanks and people start scrambling for gold. Now in 1960, the average portfolio had 5% allocation of gold. Today, it's 0.5%. So if today you went from 0.5% to 5%, and given that mine supply couldn't adjust quickly enough, all you can adjust is the price. And again, assuming that the entire 1.8 is available, when I would say less than half is. But if you get that adjustment, you get a price of 11,000 an ounce, just for 5%. So this is the real risk, because the financial assets have grown, exponentially. And then when people panic and liquidate those in order to buy gold, price explodes.
Right.
It's kind of very simple.
Well, if I remember correctly, David Harcourt was outlining that 300 tons of gold purchased is equal to $100 price movement.
Yeah.
And he outlined that if 1.5% was put into gold from this, I'm presuming this group of funds that Mr. Greenspan is going to be speaking with, would move it somewhere around $500.
Yeah.
So again,
but now we take into the issue that the Petro Yuan is being implemented. I think it's the 26th or 28th of March. And China's been sending gold to London because that's where it's going to get implemented. And then further on down, the Saudis are going to do a big IPO later in the summer. And if China ends up being a big buyer, guess how Saudi oil is going to get priced?
Yuan.
Okay. When that happens, it's a whole new ballgame.
Yeah. Yeah. Petrodollar gets nailed and
That's right.
Yuan goes. Well, is there anything we haven't discussed about this? I mean, again, I just think that we need to, as a public service, or to get the word out that you need gold in a portfolio. It's very simple, and there is a lot of resistance. I've been it my whole life. I mean, people don't understand it. They're pretty much brainwashed, from my perspective.
Well, there's a lot of myths, and you know, doesn't pay interest. Well, neither does cash in
Right.
in the bank anymore either. Right. You get negative interest. And then it's deemed to be risky and volatile. Well, it's no more risky or volatile than the U.S. dollar.
Yeah.
So
well, if you look, you're going to get me started. I mean, if you look at a $19.13, the Fed will tell you that's worth about 2.5 cents.
That's right.
So, if you had $1 million in 1913 because you had a very rich grandfather and he gave you $1 million in cash,
exactly.
105 years later, you're sitting on $1 million.
Right.
But if that was in $20 gold pieces, you'd have $60 million. Which would you rather have?
Exactly.
I mean, but people, well, gold doesn't do well long term. Oh, really?
Yeah.
Oh, that's interesting. Cash doesn't do well long term.
This is what I always find amusing, because people say, well, if you look at the last 200 years, gold has done this. Well, excuse me, but the price was fixed till 1971.
Right.
So don't tell me it didn't do anything for 200 years. It was money.
Yeah.
So but you get these kind of comparisons that they do a comparison of the equity markets to gold over the last 200 years. Well, the stocks that existed 200 years ago,
don't exist.
They're all gone. Like they don't automatically, like the Dow automatically replaces a stock. Well, that's not what happens in real life.
That's right.
When one of those 30 stocks goes down, you got 29 left.
Yeah.
Okay, you don't get, another 30.
Yeah.
So.
Well, tell us more about BMG Group.
Well, we've got the 3 funds, as you're aware. The original one, which is the Gold, Silver, Platinum Fund. Then we have a gold-only fund and a silver-only fund. But we also, for high net worth investors that want to own their own bars, we have a program of buying bars, and then we can do storage with Brinks in Toronto, Montreal, Calgary, Vancouver, Hong Kong, Singapore, Dubai, Geneva, and Panama. So if you want to spread your gold around, we can accommodate that.
And you're good for what, RSPs are they called here in Canada?
Yeah, so that's what the funds are set up, to deal with the RSPs. And we're in the process. We're going to be launching a proper version of a balanced fund. Since we've been preaching this for the last 20 years, and I thought, okay, screw it, we'll just do it. So we're going to have a fund of funds that's going to have all the asset classes in the right balance and so on and so forth. And add that to the repertoire. That's not something I originally set out to do, but it's becomes necessary. A lot of the advisors say, well, this is a good idea, but it's too much work. Why don't you guys just do a fund? So.
I know, they don't want to fill out the paperwork.
Yeah. So.
Well, I'm going to give you one story, and I want one back. We'll call it a day. So I was on the phone with a certified financial planner recently through through a call. And he basically, by the end of the call, it wasn't a long call, 10 minutes, 15 at the most, understood the gold argument and actually ended up agreeing with me verbally.
Yeah.
But at the end of the call, he basically said, but I drank the Kool-Aid. Those were his exact words. He said, as a CFP, really, I just got to stick with what I've been taught. I can't go out there. I don't want to be labeled a kook. So in other words, he's protecting his personal feelings about himself and what his clients might think about him, rather than what he's actually signed up to do, which is protect their wealth.
Well, because here's what happens is we can meet with a financial advisor, and after explaining it, he kind of gets it. He said, well, that's a good idea. How come I'm missing it? So then he takes the material, and then when he has his first client meeting, and he goes to present the investment, the client says, what, are you kidding me? Like gold, it's risky and this and that, the other thing. I have to rethink whether I'm going to use you as a financial advisor. Then he's not going to ever present it again.
Yeah.
Okay? And the trouble is, he hasn't done his homework to be able to deal with the client as to why.
Yeah.
That's a big job. And he should simply show them the portfolio and say, look, this was your portfolio. If you added this, this is what would have happened. And the client would say, well, sure, add it. Well, it happens to be gold.
Yeah. Sure. Just the facts, man. To
Right.
be at Joe Friday, let them read it.
Right.
What decision do you want?
Yeah.
Yeah, well done. Well, Nick, it's always a pleasure. Thanks for taking time out of your day to come down here and visit with me.
My pleasure.